How are you guys doing? This is Ryan. Welcome back to the channel. Today we're going to talk about selling calls and puts on Robinhood. How to do it. It's very easy to do, and it's actually a pretty conservative way to invest. Contrary to belief, people think options trading is very risky, and I would say buying calls and buying puts are, but selling them is actually much more conservative. So we're going to talk about that in this video and exactly how to execute it on Robinhood. This can work for other platforms, but I'm going to go through in this video an exact tutorial on how to get it done on Robinhood and how I use it. I'm newer to it, but I really enjoy it, and I think it's a great source to make passive income and really just another great tool for the toolkit in investing and growing your wealth. So if you like topics about growing your wealth and just adding more tools to the toolkit on how to grow your wealth, make sure you subscribe to the channel, give this video a thumbs up, and also tap that notification bell so YouTube will notify you every time I upload a video. So with that said, let's jump in the video. So let's jump into our Robinhood app. I was playing around with it earlier. Alright, so I'm inside my app and I already have two options out. I'm selling a put right now on Palantir and I'm selling a call on Hyliion. So what you'll hear people say, a put, they'll call it a cash secured put. That's because you have to put up enough cash to buy 100 shares at a particular price, and there's a premium to do that, and that's what you want to collect as a premium. So let's go look at a stock that we may want to do this on. And please know that stocks with more volatility will have higher premiums versus stocks with lower volatility will have lower premiums. And the person that really sets the premium is the seller of the contract. I can sell a premium at whatever. It's just what is the likelihood of that order getting filled is the question. So you want to put out a competitive premium price and secure the contract. Alright, so the number in this game is 100 shares. So right now I'm trading options on cheaper stocks because I'm really just starting this out. I'm using about $5,000 to $6,000 to trade options weekly on particular stocks. So let's look at a company like Carnival Cruise Lines. Let's take a look at them. They have a lot of volatility around what's going on with their ships, and I've been able to collect some good premium on them as well. So if I go over here, I hit trade on my app and go to trade options, Robinhood asks me, do I think the stock's gonna go up or down? Since I don't own that many shares of Carnival right now, I'm gonna say I think the stock's gonna go down. Because this stock I wouldn't mind owning if it were to go down more. So I say it's gonna go down, and I wanna look at the contracts for January 8th that expire on that day. So I wanna sell a put. So that's what I wanna do. All right, so the current share price is $21.69. So the closer you look to the current share price, the higher the premium is. So if you look at $21.50, the premium is 68 cents. And you multiply that by 100 contracts. So that is $68. So if I guarantee to buy 100 shares of Carnival Cruise Lines at $21.50, I will automatically get $68. But I may want a better deal on the stock, and I may be willing to get a lower premium to get a better entry price on the stock. So if I look down here, if I go to $20, the premium is currently 20 cents, so $20. So let's say I want to do that. I click put, and I have to say I want one order of 100 contracts. And if you look in the middle, there's a limit price, what I can set. The market's going from 18 to 21. Robinhood suggests 20 cents. I typically just do what they suggest for now. Let me know if you have any better tips in the comment section below. So I click review. Right now it says I do not have enough buying power to buy 100 shares. So I need to deposit the funds in order to buy them at $20. So I need to have $2,000 in available purchasing power, which right now all my money is currently in equities or securing other contracts. So just deposit the funds and go from there. So that is the concept of a cash secured put and how you collect that premium. Now, if the price goes to $20 or below, I'm likely to get assigned the shares and I have to spend $2,000 on Carnival Cruise Lines. If it does not reach that number, the contract will expire worthless, and that'll give me my cash back, the $2,000, and I get to keep that premium of $68. And the expiration date is January 8th, so I get paid $68 to leverage $2,000 for a very short time. But let's say I do get assigned the shares. I would just turn around and say I want to sell a call now. See that? I'm selling a put, now I'm going to sell a call. So what are Carnival Cruise Line calls? Let's say on January 8th I got assigned those shares, and I want to turn around and do a covered call and sell a covered call that would expire on January 15th. What are those premiums like right now? And look, the premiums are likely to be very different after January 8th. I just want to give you a look inside and see what it actually looks like. But the calls look like they're paying pretty good money right now. If I did a covered call at $23, that has a contract value of 75 cents. So let me click on that. One contract, same thing. It says I do not have enough shares of Carnival Cruise Lines for the collateral needed to place that order. But if I did get assigned those shares, I then would have them. Or I could go buy 100 shares of Carnival Cruise Lines right now and start writing covered calls on it. It's very easy to do. It's a very easy concept. It's called the wheel strategy. Cash secured put, get assigned the shares, turn around, do covered calls. The whole time you're collecting premiums on these bad boys. And this is a really good way to collect income as you get older, because you don't want to live off your principal. You want your money to make money for you. If you live off your interest, then you can have money forever and have money to give to your kids. So again, this is another tool for the toolkit. I'm gonna make a future video on buying calls and buying puts and really talk about how that is much more risky, but also the rewards are much, much higher. I don't partake in them. I actually do consider myself kind of a conservative investor, even though I do hold some pretty volatile assets. But if you wanna see those videos, please make sure you subscribe to the channel. And if you've enjoyed this video, please give it a thumbs up. And again, turn on that notification bell. And I really love this strategy and I wanna dedicate more cash to it. So if you already do covered calls, let me know down in the comments, how much cash do you deploy to the strategy? Because right now I'm only doing like 5,000 to 6,000, but I think I'm likely to get into the tens of thousands, if not like a 6-figure portfolio that is just doing covered calls and cash secured puts. And to see on a weekly basis, how much cash can I actually produce? I think you can make a couple grand a week with enough cash. I don't know. But right now I'm really getting my feet wet with it. And I gotta say, I see the value and I think it's really gonna help my returns. And it just makes me think that I could retire with a smaller net worth than I thought before. Like I always thought I needed over like $3 million. But this makes me think I could retire with like half that. Just because the return on the leveraged money is so good. And I just wanna point out before I end the video that premiums on less volatile stocks are not as good. So let's go to a stock like AT&T. AT&T is like a pet rock. It doesn't really move a whole lot. So here we are with AT&T. Let's go to trade options, January 8th. Let's sell a call, a covered call. If I had 100 shares of AT&T. They're not as bad as I thought actually. So at $28.74, if I were to buy a covered call at 29, they would give me 24 bucks, but that's so close. Like I don't want to sell my shares really. If you're doing covered calls and cash secured puts, you kind of don't want to sell your shares. It's like if I sell my shares, well, I made a profit anyways. And if you do a cash secured put, it's like I have to be okay with buying a stock at that price. So if I go a little further out, if I go to $30, I only get 7 cents per contract, so $7. So for AT&T, I would feel comfortable doing that just because AT&T doesn't move a whole lot in a short time. So again, stocks with less implied volatility are gonna get lower premiums just because the buyers of those calls and puts will pay higher premiums because they know volatile stocks will move more and they feel more likely to make more money on their trade. So they're willing to pay a higher premium. But guys, that's all I got for this video. If you also want to follow me on Instagram, I'll put my handle here, rgiffin89. I post there pretty much daily, different kind of investing tips over there. You can hit me up on the DM section. I talk to a lot of subscribers over there. And I just wish everyone a happy, healthy 2021. Hopefully it is a very prosperous year. Despite all the craziness in 2020, it was a great year for investors. And I hope 2021 is even better. I'll see you in my next one.